Hello, everybody. Welcome to our April 28th version of the Market Recap and Update. I'm Mike Hengehold, and with me, as usual, is Doug Johnson. Doug is one of my partners here at HCM, and Doug chairs the investment committee. You know, Doug, I was so taken away by that last clip of music that I think I'm going to stay with the shark theme and to lead off. I hope everybody who was around then can remember 1975 when the movie Jaws came out. Jaws was the big shark, if you remember, that made everybody jump in the theaters when the shark got close to the boat. Okay, well, so with the investment theme we want to cover today, the point here is that we have lots of sharks in the water right now. The first shark came when the pandemic arrived, and that shark is still swimming around the boat out there. The second shark came when Russia attacked Ukraine, also still swimming. The third shark is inflation, and this is not only swimming, it's doing a tail dance right now, and the threat of inflation is creating lots of problems. The fourth shark is rising interest rates. So rising interest rates is definitely swimming around the boat. The Federal Reserve is going to be probably beginning that process as early as the next week. So we'll be anxiously waiting to see about that. And the fifth shark has not been seen yet, but everybody's afraid that it's lurking under the boat. The fifth shark is recession. And the problem here, the concern is that because of the first four sharks, especially the government raising interest rates, that could bring on a recession. And a recession could be the most dangerous shark of all because it can devour a thriving economy if it really gets into a feeding frenzy. So those are the sharks that we're worried about. Investors' fear of these sharks has shown itself so far this year really by a lot of volatility. So when we look at the Dow Industrial Average, it's moved more than 43,000 points from daily highs to daily lows this year. And yet for all that sort of nervousness, all we really have to show for it so far is really a garden variety correction. So the S&P, the markets are down around 10 or 11%, give or take. So things really haven't broken loose yet, but with all the sharks in the water, we obviously have a lot to pay attention to. So what I want to focus on here at the beginning of the presentation is inflation. The biggest shark in the water right now that's circling the boat is certainly inflation. We last fought and beat inflation in 1981. Since then, and really over two generations, as a government and really most of the developed world, we've run huge deficits, spending money we did not have, which central banks were only too happy to provide because it kept everybody happy. Politicians were happy because they were getting reelected. Businesses were happy because this nearly free money gave them the fuel they needed to run their businesses and grow businesses and so forth. And people loved it because their portfolios grew and they got to buy cool stuff. And the reason we could get away with it is because there were no sharks in the water at that time. There was no immediate threat, no immediate cost to a lot of these deficits or a lot of the stimulus programs, the problems created that we face today. You know, when I mentioned stimulus programs, that does bring back, so there were two sharks that appeared in the water during this time frame. If we go back to 2008, we remember the debt crisis, and then really just at the end of 2019, beginning of 2020, when COVID surfaced. But these brought sort of the opposite problem we have today. These brought with them the potential for deflation, and deflation is a whole other bag of snakes. Very difficult problem to solve, scares central banks to death. So they would much rather be facing an inflationary problem because they believe they know how to deal with that. In any event, the result of all of this activity, the stimulus, the deficit spending, and so forth, has been a flood of nearly free money that has been driving a wealth effect. Now, what the wealth effect does, what it means is it essentially, at least to some extent, creates money out of thin air. So on one hand, we have the government providing capital, providing low interest rates and so forth. But the wealth effect, essentially, just think of it as a stock that doubles in value. If that stock gets incredibly expensive, somebody sees that in their portfolio and they feel wealthy. When in reality, it may be temporary wealth. We're in effect borrowing from the future, borrowing some of those returns from the future. But the bottom line on it is this flood of money has created this spiraling wealth effect, which, and as I said, creates money out of thin air, and in some cases creates too much money. And when there's too much money in the system, people feel richer, they're more willing to spend, and this creates excessive demand. And if we remember our Econ 101 definition of inflation, it is the, say, blank of money chasing too blank goods. And what we're saying here is too much money chasing too few goods. So from all the things we've talked about, we can understand why we have too much money in the system. Why do we have too few goods? Well, first of all, we can all remember the pictures of all those container ships floating around off the port of Los Angeles at the height of the COVID crisis. Well, most of those ships are gone now. There's still a backup there, but most of that problem has been worked off. If you wonder where the ships are, they're floating around off the coast of China right now as a result of China's zero tolerance COVID policy. And so the backup in supply still exists. It's still just backed up at the other end. In addition to that, we can add the shortages of energy, food, and commodities being brought on by the Russia-Ukraine war. And we can easily understand why we're kind of bogged down in the system. So the million-dollar question that we're looking at here internally is, has inflation peaked? And if the sister question to that is, will the measures taken to bring it down ignite a recession? And this is important because on average, since 1951, the S&P 500 has risen about 13% in the year following the peak of inflation. There have been 13 instances where this has been measured. In only 3 of those instances was the market lower 1 year after inflation peaked. And those 3 instances were when a recession followed. They were 1957, 2000, and 2008. So this is the decision that that everybody's struggling to answer. And so, Doug, I guess my question for you is, do these sharks bite?
Well, it seems like historically they have, and I think right now you've got very much a tug of war going on between the stock market and the bond market. And one of the titles of the presentation was is the market finally going to take the Fed seriously? So we'll look at that, but let's stick on the inflation theme for now. So we talk a lot about higher rates to fight inflation, but what is the inflation that we're actually seeing right now in the economy and in goods and services that we use? So these are just changes from a year ago. So you have a mortgage payment on an existing median price home, so up almost $4,500 per year as of April 1st, or 33%. Median monthly rent up almost 14%, or $3,000 per year. Average price of gas up $1.39 per gallon as of March 28th, or 47%. New and used cars up 24% as of February. Now, I will point out that in the latest CPI report, used car prices actually fell. Kind of the first main item that we've seen that's moved lower. But then things like public transportation up 18%, food at home up 22%, and food away from home up 20%. So, we talk a lot about broad measures of inflation, but here is a real life breakdown of things that people use every day in their lives, and we can see that these are real dollars being applied to these goods and services. Now, Mike, you mentioned earlier that all of those ships that used to be on the port of Long Beach or right outside of Los Angeles were all backed up, and now they've finally dissipated a little bit. And where are they? Well, they are all off the coast of China right now, waiting to get into the port of Shanghai. So this is a chart that denotes the number of ships that are waiting to either load or discharge their load at the port of Shanghai, which is a major supply chain hub on a global basis. So the ones to focus on here are the kind of dark blue. They call this an ant chart. The dark blue pattern here that shows that the number has historically been we'll call it between 100 and 200 between 2017 and 2021. Then during 2021, the number obviously jumped up throughout the year with COVID, with certain restrictions. But what was interesting was that China never really reported significant COVID increases, especially after the initial wave. But all of a sudden, the past 2 months, they have gone back to a policy that is very reminiscent of the very first days of COVID in January and February of March, or January and February of March 2020. And that has resulted in a massive spike in the number of ships that are sitting outside of Shanghai right now, almost 700 going back to the beginning of April. And what we've seen is that those numbers continue to grow. And for whatever reason, China does not seem to have any interest in slowing down their zero COVID policy right now. So when we look at the situation as it relates to inflation, this could cause additional supply chain pressures and could, maybe not send inflation higher, but maybe could present or prevent a lowering of inflation as we go forward. Now, as the market has grappled with all of this, companies have also grappled with it as well. So as companies now have their input costs going higher through inflation, they can do one of two things. They can eat those costs, or they can pass those on to the consumer in form of price increases. But the risk there is that company raises a price on a good, someone's going to substitute that good out for something else at a lower cost. So that will ultimately eat into profit margins. And when inflation is eating into profit margins, it's ultimately going to eat into earnings of companies. So here we can see of the S&P 500 companies, the percentage with both an increase and or decrease in net profit margin from the first quarter of last year. So the red bars denote decrease, green would denote increase, yellow is at a 0. And then over here we can see goes from 0 to 100. Then these are all of the sectors of the S&P 500 with the actual index in the middle. So outside of really energy, which for obvious reasons is seeing a large increase in profit margins, and real estate, a lot of these now are starting to show decreases in net profit margins below that 50% line. So as we talk about equity markets and we talk about repricing, valuations, all of these things that are going to drive stock prices up or down, profit margins are a very important factor in all of this, in the ability to grow earnings or see earnings decrease. And until we see some level of dissipation in the inflation rate, we would expect these profit margins to continue to be squeezed. Now, how is that related to the equity market so far this year? Well, we've seen a lot of volatility. So this is a year-to-date chart on the S&P 500. You've gone from January 1st down to the initial low right around March 15th, which was a drop of right around 12.5%. Then you saw a subsequent rally over 4,600, which was a gain of 11.5%. And now you've seen another subsequent drop of approximately 9.8%. So certainly a lot of volatility in the market right now with prices that are bouncing up and down. We're seeing big intraday moves. And frankly, I think markets are still trying to digest what the Fed is going to do in terms of dealing with inflation. I think everyone agrees that rates are going up, but they're really trying to determine what the neutral rate is going to be determined by the Fed. And we'll get into what that means here a little bit later in the presentation. So who's been leading in the equity market? I think that can tell us a lot about really the health of the rally or the health of the sell-off, so to speak. So these are three ratio charts that all reference back to the S&P 500. So this top pane here has the consumer staples ETF total return price divided by the S&P 500 total return price. Now, when we see this line moving up, all it means is that the consumer staples sector is outperforming the S&P 500 over the past year. You move down to the value factor, little bit of a mixed bag here. We've seen periods where it's gone down, periods where it's gone up, but for the most part, it's kind of gone sideways or a little bit negative. And then lastly, you have growth ETF with the S&P 500 again, similar mixed bag here where you see increase and then a strong decrease here, specifically in growth since right around November. So what does this tell us right now? Well, historically, when you see defensive sectors like staples outperforming the market, it's around times where people are getting defensive, and it's just historically been a time where markets have had a lot of headwinds. As we look at the two other sectors here, both value and growth, with the mixed bag, and we've talked a lot about having a value bias, but what we're also seeing here is a kind of bifurcation within value, where you're seeing things like energy and defensive value starting to perform well, where with concerns about growth slowdowns, and we'll talk a little bit more about that as well, the cyclical value or cyclical areas of the market are starting to get hit a little bit. So financials specifically, which has caught a lot of people off guard because historically when rates move up, financials do well, but that's not happening right now because financials are a more cyclical part of the market. And I think the growth story, we've touched on that. Historically, growth has not reacted too kindly to rising rates. And we've seen a lot of this, the darlings of the market through the kind of COVID rally, so to speak, have really been hit hard over these past 6 months, specifically things like unprofitable tech or stocks that are considered stay-at-home trades. Now, going back to that value growth theme, here's just a longer term look of value versus growth on a 10-year rolling average going all the way back to 1940. So obviously a lot to take in here, but what I want to really focus on is this area right here. And why is this area important? So you take this from about an inflection point, we'll call it about 1970 all the way up to the early 80s. So Mike, I'm going to put you on the spot here a little bit. What happened between 1970 and 1983?
Well, we had some inflation.
Some inflation or a lot of inflation?
We had a lot of inflation. And I would add, it's interesting when we talk about these long-term cycles that, because we're talking a lot about interest rates. Interest rates spiked, peaked, I believe, around 1981. And their previous trough, I believe, was like in 1945. So when I said earlier something about multiple generations while the cycle plays itself out, it's not unusual to have these really long periods going in both directions, which I suspect is where you're headed here.
Yeah, exactly. So Mike was right. we had certainly a period of very high inflation through this. And we can see that as that high inflation kicked in, values showed very strong performance against growth. Now, as rates started to come down, and we've seen this 40-year trend down in rates, yes, we've had some zigzags here, but if you drew a line from right here to here, the trend becomes pretty clear that growth has been dominant during this time frame outside of the tech bubble in 2000. So where does that lead us going forward? Well, if we're entering another period of sustained inflation, which is certainly a possibility, and looking more likely as we move forward here, we've seen this line start to move up as the expectation that value will perform well, but that some of the growth or growthier parts of the market are going to have a repricing that in some cases is going to be very severe. And I don't want to mention individual stocks on this call, but over the past few days, you've had a few very high profile, high growth names that came to prominence during COVID that have been absolutely decimated. Not only the past 6 months, but just recently over the past few weeks. And some of those, I think investors have kind of anchored to those all-time highs and said, well, this is a great value right now because 2 years ago, the stock was trading at X, and once it gets back there, this will be a steal. Well, it may never get back to those prices, and I think that's something that investors need to start to consider as they look at opportunities going forward. I think one of the best examples out of the great finance or the tech bubble was Cisco. Cisco was the original $1 trillion market cap stock. It didn't quite get there, but it was touted as the one that was going to do it. And if you look at the market cap now versus its peak, it still hasn't gotten back to that level. And that was almost 20 years ago. And Cisco is a great company. So, very, very much a bifurcation in the market, not only between value and growth right now, but within each of these styles in terms of what is going to work, what we believe is going to work going forward, and what is really going to struggle. Now, international versus the U.S., this has been a topic for seemingly a long time, and the struggle has always been international has the fundamental setup, and everyone's waiting for it to outperform, and it just, for whatever reason, cannot get it done. Well, this is showing from a valuation standpoint, this is the MSCI World Index minus the US versus the S&P 500. And these are bands of standard deviation. So standard deviation is just, a way to judge how far away from an average level that a certain reading is. So when we look at this chart, what it's telling us is that international is as cheap versus the US as it's been since 2005, almost 2 standard deviations below. And statistically, that's a pretty significant level. So as we continue to talk about international, the setup remains there. Obviously, we've got some headwinds with the war in Ukraine right now, affecting a lot of Europe. You've got the issues in China going on. You've had a really strong US dollar that's put a lot of pressure on emerging markets. But when we come out of this, if you are constructive on the US and your thesis is that all of these things that we're dealing with right now are going to dissipate at some point, then in reality, you should love international because the pricing around the world versus the United States is as cheap as it's been in a long, long time. But for whatever reason, the catalyst still has not been there. So, for us, we have been, versus our benchmark, we've been underweight international now for almost a year, but we still hold a decent amount in our portfolios. I think waiting for this relationship to turn around a little bit, but we think when it does, you could see a pretty steep outperformance like we saw back in 2006, and then again during the Great Financial Crisis. Now, one of the main bullish arguments for the equity market right now has been sentiment. So people have made the argument that everybody is so pessimistic that the market's going to have to turn around at some point, or it's going to have to find a bottom. But what I think you're seeing a lot of is we'll call them bullish bears. So this is showing the University of Michigan consumer sentiment in blue, which is, almost at the lowest levels we've seen since the great financial crisis and right after. And then you're seeing the actual asset allocation to equities from the AAII survey, which is the American Association of Individual Investors. So on the sentiment side, everybody seems to be pessimistic, but where they're actually allocated, they still own a tremendous amount of equities in their portfolio. So I think what we're seeing is a lot of, as the title implies, a lot of bullish bears right now. People who are concerned, they're looking out over the landscape and they're seeing all of these problems, but they're also seeing what happened coming out of COVID. They're seeing what happened in 2018. And they saw that the Fed stepped in and saved the day, and they don't want to miss out on the possibility that we're going to see another V-shaped type recovery. But what I think might be different this time is that the Fed is really going to be in a box here, and I'm not sure how much they're going to be able to do to help this situation. Now, have evaluations adjusted to any of this? This is a valuation chart that presents it in a little bit of a different way, but I think paints a really good picture. This goes back to 1950. And this dotted line here basically shows a fair value of the S&P based on the modern era PE of right around 20. And then this line is going to show the PE equivalent, and the colors are what's important here because it shows really the under or over valuation versus the average. And again, we see that standard deviation word again. So when you see this yellow and red, that's denoting 1 to 2 and over 2 standard deviations above what would be considered fair value on a PE ratio. And then this green area would be considered below fair value. If you wanted to put it into, opportunity terms, this would be very attractive on a valuation basis. This would not. And again, this would not. Now, the one thing that we've always said about valuations is they're not a short-term market indicator. They never have been, they never will be. But what they have been very accurate in is predicting future returns, specifically what the returns are going to be for the next 10 years versus what historical averages have been. And when you see PE ratios way above average, that means that the probability that you're going to see lower equity returns going forward is elevated. Now, the last time that we saw this green area here was at the tail end of this giant inflation boom that we saw in the 70s. So have valuations adjusted to what may be coming down the road? I'm not quite sure yet. But if they do, we're probably going to see, again, some headwinds for equities as they try to reprice all of this. Now, price is one factor to a PE ratio. What is the other? Earnings growth. So what are we seeing on the earnings front? Well, coming out of COVID, we saw unbelievable earnings growth numbers because they were coming off of numbers that were extremely low. So you had a huge trough, huge growth. Now that's starting to normalize, and we're getting rid of those base effects. So what is the S&P 500 showing for this quarter? So right now, we're seeing about a 6.6% growth projection. And this has been a big week for earnings. So we don't have all the companies in the S&P 500 having reported yet, but a good majority of them will have reported after this week. So 6.6, while it's a good number, it's certainly not to the levels that we've seen recently. And the question is that going to be enough to justify prices and specifically PE ratios where they are right now, considering all the things that we have coming down the pike? Now, switching to economic growth, we've talked a lot about stagflation, and stagflation is the idea that you have high inflation coupled with bad economic growth going forward. So we certainly have the high inflation portion of this. The question is, what does the economic growth picture look like right now? So this is the Atlanta Fed GDP Now real-time estimate, for the first quarter of this year. So the estimate as of a few days ago had fallen all the way to 0.4%. Okay, so when we're looking at this versus consensus, when we started way up here, This has been a one-way street, lower and lower and lower. Then we get the reading today, and surprise, the actual number was negative 1.4%. So we look at that, and what does that tell us? Well, there was a pretty big adjustment for exports in there. So some people are throwing that out and saying, it's not as bad as it seems. But whether or not we can say this is going to lead to recession or not, what I think we can all agree on is that growth is certainly slowing down. And as growth slows down, that is going to affect certain areas of the market differently. We've talked about the cyclical value areas. So things that are more dependent on some idea of reflation may struggle a little bit more than they had in the past for some of the more defensive growth sectors. Now, on the flip side of that, you've got this tug of war on the growth side, where historically high rates have not been good for growth. But when there's no economic growth to be had, and you need to find pockets of the market that can grow in any environment, some of those growth names might start to look attractive again. Probably not the ones that, again, were the COVID darlings, but some of these mega cap tech names that produce money hand over fist, that even though we're going to possibly see some slowing growth in some of those names, they could almost become pseudo value in an environment where we're seeing slowing growth. The other unusual thing today was that, 20 years ago, if you saw a print like this on GDP, you would not expect the market to be up almost 2%. But you're getting back into that mindset where, hey, maybe this is bad enough to where it gives the Fed some wiggle room here, and they don't have to be as aggressive with rates, or this is going to give them an out to somehow now start to slow this down. And you get back into this tug of war game between bad news is good news, because it means the Fed won't have to do what they say they're going to do. That's yet to be seen. They're in a completely different situation they have been in the past. But I'm very interested to see how the market's going to react to this growth number going forward. Now, has the Fed been tough on inflation? They've talked a lot about it. What are their actions saying? So here are the total assets held by this is basically the Fed's balance sheet going back to April 20th. Now, we can go start at February 16th here, 8.91 trillion. We're up to April 20th, 8.95 trillion. So for all of the trepidation that the Fed has had about inflation and fighting it, and that's their main concern, they've actually increased their balance sheet by a few $100 billion during that time. So what does that mean for Fed policy going forward? Well, again, we talked about what is the market expecting. This is a Twitter poll that I pulled. Granted, it's not not a large sample size. You have 580 voters. So some people would argue maybe this isn't as scientific as it needs to be. But nonetheless, look at the answers. The question is, when will the markets force Powell to pivot again? And if you look at the answers, 80% of this say that this is going to happen sometime soon. So 22% this quarter, 41%, almost half, are saying this year. Next year, 17.9, and then you have less than 20% of the respondents saying that this time they are not going to pivot and worry about the market. They are strictly focused on inflation. So that mindset,
hey, Doug,
yeah.
Would you just define what you mean by pivot?
Certainly. So pivot basically means that right now they are committed to a policy of rising rates and reducing the balance sheet. So a tightening of policy, so to speak. A pivot would mean that they would find a way to reverse that, either lowering their interest rate expectations, actually cutting rates, or doing the same with the balance sheet, where they stop reducing their balance sheet and or actually start adding to it again. So going from a quantitative tightening to a quantitative easing.
So this would effectively take at least two of those sharks out of the water.
Exactly.
That's what they're talking about.
Yeah. So what are these new Fed tools that they talk about? Well, this is a picture of Jerome Powell praying, please make inflation go away. I don't know if he saw that print this morning and he was doing cartwheels, or he was nauseous over his trash can. But I've said this kind of tongue in cheek. I don't know that the Fed wants to be responsible for what needs to be done in terms of squashing inflation, and they're really kind of jawboning as much as they can before they actually go through with anything. But they're really going to be put to the test now, because they're meeting next week. There is almost a 100% chance, based on market pricing, of a 50 basis point increase. We haven't seen one of those since 2000, which has been quite a long time. Now, we've talked a lot about equities. What has this done to the bond side of things? Well, it's been a pretty ugly picture for the bond market in the beginning of the year. How ugly? Well, it's been historically ugly. So this is every return iteration going back to, I believe, 1970 for the U.S. Ag Total Return Index. Now, obviously, a lot of these lines are hard to decipher. So obviously, the one that's not is the one that we're through right now. So this is the thick black line here. And while this number is tough to read, it's pretty easy to see that this is way below any iteration that we've seen going back a long, long way. So the worst year for bonds so far has been 1994, with a total year return of negative 2.92. You jumble those numbers around a little bit, and you get the number that we're seeing right now in the bond market, based on the U.S. Ag being close down close to 9% so far. So a very, very big number that we've seen in the bond market. Now, talked about the terminal rate earlier. What is the terminal rate? So the terminal rate is just the rate that the Fed feels like they need to get to on the short end of the curve in order to sufficiently fight inflation. So this gives a good representation of kind of the evolution of that terminal rate over time. So back in March, market believed that the terminal rate was right around 2.23. 2 weeks later, they thought it was going to be 2.7. 2 weeks after that, they thought it was going to be 3.07. 2 weeks after that, they thought it was going to be 3.38. So obviously, this is a moving target right now. And the higher this terminal rate goes, the more volatility I think you're going to see in the bond and the equity market. But anything that would cause this terminal rate to move lower, I think, is going to be good for both stocks and bonds. But until we get a better idea of where this is going to end up, I think the volatility is going to continue in the marketplace for the time being. We talked about the probability of a 50 basis point rate hike the next meeting. Well, the probability of a 75 basis point rate hike, which we haven't seen since 1994, which would assume a 50 basis point rate hike in May. So this would take it from 0.75 all the way up to 1.5 at the June meeting. As of April 22nd, was 87%. That is a really, really high probability of a really, really big rate hike. So what does all of this mean? Mike talked about the wealth effect. Well, this kind of talks about that the Fed believes it can aggressively hike rates. They can lower stocks and create a reverse wealth effect, cool demand, lower inflation, without being concerned it's going to cause additional unemployment. We talk about threading a needle. This is probably shooting a bullet through a thimble at 1,000 yards, in my opinion. They're going to have a very, very tough time pulling all of this off. So on the bond side, we mentioned in the title, is this presenting us with an opportunity on the bond side? Just like in the equity side, if you see the market getting oversold, from a sentiment standpoint, it can present an opportunity. How does this look on the bond side? Well, sentiment in bonds is extremely bearish. So we have to go back to 2004 and 2009 to see as much pessimism as we've seen in bond treasury futures. And in the past instances, that's led to a kind of bottoming effect in the near term. We also saw it around 2018, same thing. So could there be a short-term bounce in bonds and a lowering in yields? Absolutely. What that's going to look like long-term, again, I think matters on both the growth projection and the terminal rate that the Fed's going to get to. Now, put those two things together, and what do you get? Extremely tough conditions in the first quarter. So there was basically nowhere to hide. Stocks and bond investors got hit from both sides. And if you take the performance quarterly the best performing asset class quarterly between stocks, treasuries, investment grade, and high yield. And again, this was published right at the end of the quarter, so this number is much lower right now. You'd have to go back to 1980 to see a quarter that had this much difficulty generating return in those two pockets. So historically, we haven't really seen those pop up to that magnitude. And you've only really had once where you've seen it in back-to-back quarters in 1994. So, Mike, I'm going to let you take what I would call the bond case or the bear case for bonds right now. If we were talking to a client or somebody was asking us, what is the compelling case now to just get rid of bonds for good?
Well, I'm not sure I would tackle it
maybe not getting rid of them for good, but getting rid of them for now.
If I was making a 50-year decision, I would obviously get rid of them for good. However, bonds have an important role to play in a portfolio. And the first quarter that we've had this year is really an outlier from that perspective, as Doug's pointed out very well. The thing that I think that's most important to remember here is that the Fed has a particular job. It has two jobs laid out in the statute that created it, and it's to manage employment and promote stable prices. Nowhere does it say support the stock market, because they deal specifically with interest rates and debt. They're tied much more closely to the bond market, but it's not their job to support it. So going back to what Doug was describing earlier, will the Fed pivot? They have done so in recent history, really going back to Alan Greenspan, the sort of a coined the name the Greenspan put, and now we call it the Fed put, but it's when the market gets into trouble, they come riding to the rescue. But again, that's because generally speaking, there were no sharks in the water. Now, with their clear mandate is to protect the economy, protect stable prices. If inflation is getting out of hand while employment is not a problem, it seems they do not have much wiggle room to do anything but stay steady against the inflation fight. And staying steady against the inflation fight is going to mean raising rates and draining liquidity. So when we talk about the wealth effect was created by too low of interest rates and too much liquidity. So we've seen this movie before. We've just seen it running in the other direction. Now the movie's playing backwards. And it seems logical that if the Fed has to drain liquidity, and if they have to raise interest rates in order to properly tackle this threat of inflation and keep prices as stable as possible, that's going to be bad for bonds, at least over the long run. Certainly, I would concede we could get a technical bounce, especially if the market becomes convinced, or if the Fed surprises us at the next meeting with a lower than expected or lower than feared interest rate increase. We could certainly get a bit of a rally, but with as much embedded inflation as we have in the system, it's going to be hard not to have that inflation fight be a long one, and that has to be bad for bonds when you consider the fact that the bond market rally we've been in literally until the beginning of this year started in 1980 when Reagan and Volcker were in the White House. So that's how long these cycles last, and it seems painfully obvious that this could last a long, long time, certainly with technical corrections along the way. Does this have to happen? Well, the laws of supply and demand will kick in. If you want to buy a can of green beans and they're all sold out of the grocery store, but somebody has some, in front of the grocery store and they're offering for auction, you can bet they're going to sell them for a higher price than was the case when there were 100 on the shelf. That's just the basic law of economics. So when we have the Federal Reserve now beginning to shrink its balance sheet, it's going to be putting bonds on the market, and there are going to be, so they're going to be a big seller. They have to entice buyers. Well, who wants to buy a bond when it's paying 0.05%? Nobody. So now the auction price goes up, and that's essentially the interest rate. So interest rates have to go up to entice buyers back into the market, a la rising interest rates. And as we all know, the teeter-totter effect, rising rates is bad for bonds. So over the long run, while they're shrinking their balance sheet, that's almost a baked-in bear case for bonds. Then, we've been through, since the 2008 real estate crisis and debt crisis, we've been in a situation where the government reduced interest rates so much to stimulate the economy. And of course, now we're seeing some of the after effects of that. But what it did is it took interest rates so low that they were negative in real terms and really set it in motion so that savers could not make any money. People could not go to the bank on an after inflation basis and make a real return, I'll say, like they did in the old days. And so assuming that the government, the Federal Reserve, and policymakers are going to allow interest rates to move to a level where savers can actually make money, and the government allows people to have a conservative portfolio with at least a modest return potential, interest rates don't have to just go to the Fed's sort of stable or neutral rate that Doug was talking about before. They have to establish a margin or a premium above that. So the Fed, we always talk about the CPI. They use a slightly different benchmark, but let's call it all the same for the sake of this discussion. They would like to see inflation settle somewhere around 2 or 3%. So if a saver is going to make a real return, that means they have to make 1.5% or 2% at least above that number. So that puts us in the 4 to 5% target range for market rates going forward. And we're not there yet. So that would imply rates have to go higher. And of course, that would also be bad for bonds. Same basic policy with banks will charge a premium over their cost of capital so that they can earn a profit. So banks can make a profit on a fairly modest premium. 1.5 to 2% makes banks pretty happy. But again, let's assume we settle into that 2 to 3% inflation rate that the Fed just targets, and we're still looking at rates higher than we are today. So I think when you add it all up, when you look at these long-term trends and look at the forces that are in place, it's difficult to see bonds being a good investment for any time in the near future, other than technical bounces.
Okay, so now let's look at the other side. Well, what might be the bull case for bonds? So Mike just mentioned the technicals. So you've got sentiment and technicals both showing bonds extremely oversold, in some cases historically oversold. Now, if the aggressive Fed raises rates into a slowing economy and generates a recession, usually that's going to generate some kind of demand for fixed income. So we've seen the slowing growth right now. If the Fed really has to get aggressive on trying to rein in inflation, you may in fact see investors say, okay, we're concerned about what this does to equity prices, and we're concerned with what it does to economic growth going forward. We may grab some bonds, or at least longer term bonds, to counteract that. Incremental increases in yields are going to start to generate new demand from investors looking for income. When for the past 10 years or so, a 2-year bond would basically pay you nothing. Now you can get almost 2.5% on that. For investors who are trying to generate some level of income with some level of or lower level of volatility, so to speak, it's not a bad deal for them. Reversal of excess stimulus from COVID, along with inflationary pressures, will limit consumer spending and therefore economic growth. That kind of ties back into the recession fears as well. And I think this last one is probably the biggest one. Any hint of peak inflation, so a resolution in the war in Ukraine, an opening of China, and or a Fed pivot, in my opinion, is going to quickly reverse the trend in yields. And you could see money flowing back into bonds as the concerns about inflation and an aggressive Fed kind of go by the wayside, so to speak. So what are some alternatives outside of the equity and fixed income market that you may be able to use to generate some returns in this type of difficult environment? So there's a lot of different alternatives in the alternative space. Here we just listed a few. So managed futures are one. It's basically a type of quant strategy that employs trend following across different asset classes. So currencies, bonds, stocks, commodities, rates. It has the ability to both go long and short. And has historically been able to provide some level of protection or even gains in highly volatile markets. Now, managed futures have certainly woken up over the first quarter. They've had kind of a tough go of it with interest rates being suppressed by the Fed. But those are strategies that are starting to work in certain areas. So internally, we've taken a long, hard look at those and assess whether or not those could start to make sense in some of our allocations. I bonds we included in here because we've gotten a ton of questions about them. We can't buy them directly, but basically what it is, it's an inflation adjusted bond that is purchased directly through the Treasury, and the yields are more in line with actual inflation. I believe the next iteration interest rate will be close to 9% based on where inflation is. Now that rate will adjust every 6 months, and there are some purchase caps and other limitations with these. But if you're interested in learning more about these, certainly reach out to your advisor and we can kind of walk you through the process of what those are. Global macro is a strategy that we've already employed in our portfolios in the fixed income space. These are strategies that base their holdings more on overall economic and political views in countries or macroeconomic principles. They also have the ability to both go long and short, and for the most part, can generate a decent level of income for what I'd call lower volatility profile. And as I mentioned, we have 3 global macro strategies in our fixed income sleeve that we added back in January of 2021. So they've been in there for quite a while. And then finally, with inflation being the way it is, real assets. So these are physical assets that have kind of any intrinsic worth due to their either substance or properties. You have both public and private offerings there that are included but not limited to things like metals, commodities, real estate, land, equipment, and natural resources. And obviously, we've seen a big run up in commodities over the first part of the year with inflation being very high. So as we're kind of buttoned up against time here, so we've gone through all of these things. So what are we seeing in terms of base case and how that relates to portfolios? So the Fed continues to talk a big game, but now it's time they have to back it up. If they don't go into the next 2 meetings and aggressively raise rates without a major change in the data, I think their credibility, what little bit is left of it, will be completely gone at that point. The rally that we've seen off the lows in March has now been pretty much erased as the Fed continues to warn the market of a desire to reduce demand. There was even a reference about, if stock prices don't go lower, then we need to make them go lower. I can't remember exactly what Fed president said that, but that was an actual comment. So is the market finally getting the message that there's a different mindset for this Fed? Or are they looking at this and saying, nah, we're still going to call your bluff. We don't believe you're going to do this. The bond market is still attempting to find the Fed's neutral rate. It's going to cause significant volatility along the way. But with the slowing growth that we're seeing, we could be seeing kind of a topping process in rates over the short term and even possibly a reduction in yields as we move forward on a technical basis. Geopolitical concerns obviously remain in the COVID situation in China. These are adding additional supply chain pressures. And then, quite frankly, without a significant reduction in inflation and or a Fed pivot, I think equity markets are going to likely remain under pressure for the foreseeable future. Now, that doesn't mean that they're going to crash. I know a lot of people think that, less than optimal forecasts always result in 30 to 40% market declines. That's certainly not what we're saying. But the idea that the 10 to 20% equity ramps that we've seen over the past 2 or 3 years, I think those are also not going to be on the table for this year. So where does that leave us? So we remain positioned for a high inflation regime with the expectation of Fed tightening and the possibility of recession. So we currently have a small underweight to equities in our advance and defend tactical models, and that remains currently. So we remain with a value bias, but we're closely watching the cyclical side of value to see how it reacts to some of these slowing growth estimates and whether or not we have to adjust that to possibly add more defensive positioning within that value space. Our fixed income remains diversified. We hold cash, we hold global macro. We do still hold a decent amount of core bonds. That is something that we review almost weekly, looking for other options for that. And obviously that's been a big topic on clients' minds. And then, with that said, we continue to explore the possibility of adding other asset classes, such as managed futures, other bond alternatives, or real assets. We also mentioned private placements in there. Those have a more specific solicitation requirements, so we can't really talk about those on a general call like this. But if you're interested in hearing more about those, again, reach out to your advisor and we can take a look at those if those would make sense on an individual basis. And then lastly, keep an open mind. There's a lot of sharks in the water right now. And there's a lot of mindsets that I think that have been ingrained over the past 15 years that are maybe causing some anchoring to some ideas that may be changing here. So we're continuing to keep an open mind, looking at all the data as it comes in and trying to kind of put this puzzle together as we get the pieces. And lastly, a good quote from James Anderson: financial markets suffer from a deep inability to price patience because of their dominant short-termism. So I think another issue has been, as we've seen all of this activity going on in the market, this desire to quote unquote do something, but sometimes the hardest thing in markets, but the best ultimately is to do nothing, or at least do nothing until you have sufficient data to feel like you've got strong conviction. So I know we're butting right up against an hour here, so I want to try to answer one question that we had sent in. It was, what is the outlook? What is your outlook for stocks and bonds? Hopefully we answered that kind of during the presentation. If not, we can give more specific answers. But are we concerned about a recession going forward? From my perspective, I don't know that we're necessarily concerned about a quote unquote encyclopedia definition of a recession going forward. What I can say is there's certainly evidence of slowing growth, and with the other side of that being the Fed looking to tighten into that, the mixture of those two things I think could certainly kick off a recession. Right now, the employment picture is still very, very strong. So I think recession concerns from that perspective are not quite there yet. But if you have an aggressive Fed coming in, you certainly could start to see growth deteriorate to a point where recession kicks in. Now, historically, that would be very bad news. But if that leads to, like I said, if that leads to a Fed pivot, you could see all this turn around very quickly. And in this kind of crazy backwards, market that we're seeing now, you've got to kind of think 2 steps ahead and almost backward in certain areas like that. So, Mike, do you have anything to add to that?
In my 1 minute that's left, I just two things, I guess. First is just a reminder, while this may not be the rosiest scenario we've ever offered, we certainly are not predicting the future here. We are letting everybody know that we are very aware and prepared from a planning perspective, which I think is the most important part, because these cycles come and go. They always have and they always will. There's nothing we can do to stop it. But on the planning side, know that we have 3 different levels of defense in place to support people's income and distributions during retirement, starting from time diversification within the portfolios, bond ladders, which everybody's familiar with, and guardrail protection, which is a way to guide distributions in the future should everything hit the fan. So know that from a planning perspective, we are always prepared for things to come out of the blue on us, and this certainly is not coming out of the blue. We're paying very close attention. So that was really the summary point I had from that perspective. Otherwise, expect us to be back again next month. We typically shoot for the last Thursday of the month. You'll get a confirmation of that coming up. Again, any questions unanswered, I think Doug mentioned this, shoot us a note and we'll get back to you on that. And I think that does it. If news breaks in between, we'll certainly be here. Thanks everybody for tuning in. Talk to you later. Bye-bye.